So now you talk about availability, right? So one is, access. Now that you spoke about things, institutional changes, etc. But there are many, that funds, any money is like flowing water, right? It will find its own path wherever the maximum return is. That's the property of money. And if you remember the financial reforms, etc., that we get to hear of, one of the key areas of reform has always been making capital move across boundaries without much of trouble, right? So with that, obviously there are funds available domestically. There are foreign institutional funds. There are host of funds, right from angel to private equity, and even for that matter, family fund, etc. available. So what we will do is, having understood a little bit about the problem of access to fund, now we talk about availability, because in this room we have entrepreneurs who probably are looking at how do we really get that kind of fund for our growth. I want to grow my business. So to discuss that, we have three very interesting personalities here. We have Neha Aggarwal, who is the principal investments Mumbai Angels. And you would know Mumbai Angels is something which is very interesting. I know about Mumbai Angel. Mumbai Angel actually had partnered. There was an organization in Calcutta Angel, who had kind of eventually merged with Mumbai Angels. So there are a lot of very young investors locally who are actually trying to help discover opportunities and then fund them. So, and then we have Neha Malhotra, who is the managing partner, MeritX Ventures. So again, this is something which probably looks at, I'm sure they probably have some thematic, priorities, etc., where they look at funds, etc. And then you of course have Arnab Ray. Arnab was kind enough, he had actually participated in quite a few of our digital sessions online. So, and each one of them, we had requested them, because see what happens when you are talking about funding, you have to prepare yourself, because the speakers earlier, particularly Aryan, spoke about that you have to prepare yourself in terms of how do you present, what kind of stuff do you have, your team, etc., etc. So those are things that any funding organization would look at to be able to assess, because this is not a traditional, none of them they are traditional bankers. They're not really HDFC or SBI or someone. So they have the ability to take much higher risk. So if they have the ability to take much higher risk, obviously they have to figure out ways of de-risking their model. And this is where the beauty of getting into some kind of a due diligence, the first impression, the elevator pitch, and all that kind of comes in. So you have why it is important and how to go about it. Maybe this is what you probably will help us understand.
Thank you so much. So I'll just before I actually get into that point, just to set the context, Mumbai Angels is an angel investing platform. So anybody who has good idea, good startup it's like you probably would have seen Shark Tank, right? Anybody who has not seen? Alright, something very similar to what you see at Shark Tank. We evaluate those propositions to check if we can invest and we can get some return there in future. So now talking about the topic here, so I will try and put investors' perspective in place. So why do we need investor first of all? Three things, 3 C's we call it: capital, connections, and counsel. Now why would investor put in any in such high risk asset class? To see some financial return, to be part of your success journey. If you are investing at an early stage, you are looking at a return of at least 10 to 15x. If you are investing at a late stage, you will look for a return of around 3 to 5x, just on a higher end side definitely. So now what else investor look at to evaluate that kind of return, to take a call whether I should invest in that opportunity or not? Couple of things. First would be what you said, aesthetic, which I think my co-panelist Neha would be talking in detail. The pitch deck. The second would be to evaluate if that business has any potential to scale. What is the team how does their supply chain work, what is their unit economics. We understand it's a new business, it is right now making loss. What is, when and how will it break even and actually be able to generate profit? Yeah, the competitive landscape as well. So these are just a basic evaluation which anybody would look at before actually proceeding and negotiating with the founder on, we call term sheet or certain definitive agreements. Before that, we also do a proper due diligence. I think the expectation is like the list of documents with what all is required to be prepared for the due diligence by the investors. So for this startup, for what we actually do, there are four key due diligence we look at. One is the legal due diligence, legal and secretarial, two we combine it. So we look at all the agreements with your suppliers, with your vendors, with your distributors, even internal with your teammates, your own employment agreement as a founder. If there were any shares allotted to anybody else, the paperwork for that. So these are all combined. And obviously, I mean, if you are a private limited company, which you need to be for the venture capital, there are certain companies at the law ask you to hold certain board meeting, record the minutes, and all these compliance is also checked during the due diligence. The second part would be the financial and tax due diligence, where we analyze your financials, you see the financial statements, which includes cash flow, balance sheet, profit and loss statement, along with your bank statements. So this, along with certain, obviously there are these, the way the startup, the company keeps their book, that is also required to validate where has the cash flown, inflow, outflow, is it all for the office purpose? Tax regulations, are you complying with the tax? Are you paying your, whatever the tax levied on you, GST, TDS, whatever is there, are you paying that in time? If not, what is the exposure of any penalty the startup may have for that? Now, having said like this may be looking like a jargon and very difficult, very long list, it is, but there are certain aspects like, okay, in the due diligence, it may come that something is not done properly by the company. There are always ways to rectify it. There are certain red flags which literally highlights no go. Like if a founder actually took some expense, took some money out to build furniture of his home, that's a big no. But if a founder was late in paying TDS, or if a founder did not get certain certificate which was required by the law, that could be an oversight, and we could look at how it can be rectified so that we can move forward with it.
So what about the quantity and the qualitative aspect of it? Because you spoke about both, but if you can just talk about, let's say one is the 26 documents that you have to be able to deliver.
Yeah.
But having delivered, so how do you, so the due diligence for the qualitative part of it, so what does it involve, and how much of a preparation that is expected of the startup founders to be able to withstand that kind of qualitative change? If you want to kind of talk to that.
So there are two aspects. If you talk about the qualitative, it is more about the commercial due diligence, where we establish that what the startup, what the company is building, is it a disruptor, is it a differentiator, or is it a traditional business model? Where does founder, how does he start this? Where does this, it's his passion, it's his clear understanding, it's his clear growth plan. Does it align together? So these are all the qualitative aspects which I don't know, you don't really have to prepare. If you know that what you're building it right, then the investors, you can convey it to them. Whether you are, creating a need or addressing a want, those kind of analysis, that is what we cover in the qualitative. The quantitative is more detailed in terms of the agreements, the unit economics, those kind of things.
And so in terms of numbers, how good they should be in terms of all their numbers, if you can talk to that.
Sure. So in the ecosystem, there are all sort of investors who would invest in idea stage, that is mostly accelerators, that will invest in very early traction or a little post idea but still pre-revenue. It could be a clinical trial product. It could be something which is at after POC on certain alpha beta testing. So there are startups, there are investors who are also investing at that stage. Then obviously then it is all, you have early traction, you have growth, you have late traction. There are investors at all that point.
Right. So now I go to probably will jump and go to Arnab. So Arnab, we of course we would expect you to talk to the point of investment landscape. So one is this room. You probably have a sense of, since you interacted with some of them in the past, you have a sense of the kind of the startups that you have. So they're probably thematically organized around 2-3 domains. So with that in background, do you want to kind of calibrate a little bit and share with this team as to what is that they should keep in mind in terms of for preparing themselves for the investor pitch, etc.
So where I'm coming from is, I hope I'm audible, right?
Yes.
So where I'm coming from is, I've been in the industry, startup industry for the last 15 years. We have about 12 ventures in the portfolio, invested in around 6-7 out ventures. Helped around more than 2,000 startups through a venture called Big Expert. Somebody raised a query about organizations helping business plans, so we do that. We have been doing it for 15 years now. So, and we have been sitting across the investment tables to help our clients on multiple occasions. Now, before going to the landscape, and I'm going to tell you something which might not be very popular among the investors, but this is the truth, hard truth of the market. There are 3 kinds of investors. The first kind of investors, I'm talking about purely early stage investors. I'm not talking about Series A, Series B, Series C funds. I'm not talking about big VC funds. So I'm talking about fresh recruitment of entrepreneurs. And why I'm calling it recruitment? Because the first kind of investors are like that. You will find a person, forget about the idea, forget about the POC, forget about the MVP. You'll find a person who has an amazing profile. As an investor, can I repackage this person, repackage his idea or her idea, repackage the entire business model and sell it to the next investors, who's going to be slightly bigger than mine, right? This is very much a tendency which is seen across India right now. Because we are nascent out here, we haven't really got an understanding of what kind of ventures really work and what kind of ventures doesn't really work. Even the biggest of the VCs like Sequoia, probably the biggest name in the market, has also done major dogmatic errors in investment. SoftBank has done it, but at the same time we have seen amazing rise of unicorns, which again feeds our industry. So nascent entrepreneurial ecosystem doesn't allow us to have enough empirical localized evidences to understand what kind of businesses should work and what will not work. We're still experimenting on that. So first kind of investors are recruiters. I'll find an IIM guy who has worked with Bain, worked with McKinsey, does profile sales. What you're doing, maybe I'm selling water bottles, forget about water bottles, let's do a contract of B2B contract of water supply or make-based manufacturing. Because I know this profile, I know getting the investments around that person, getting people around that person is going to be easy. All I have to do is repackage and sell to the next. Let's not argue about the intention of the investors out here. This is the market trend. This works. The second kind of investment, if you don't have a profile, right? Not everybody gets to get into Ivy League colleges. Not everybody gets to work with the top Fortune 50 companies or what do you call it, the cream de la cream companies, or have a growth path in their career. And in that case, what happens? Then your idea and the POC and your business matters. At that point of time, getting funded of an idea is pretty much out of the question because you don't have a profile to showcase. At that point of time, you have to go there and showcase initial traction, initial POC, and the most important term out here for investment in India right now is called TAM. There's a target audience, target market that you're gonna cater to. If it's small, investors are not going to be interested in. And I'm purely talking about equity-based investors. And why am I telling that if a small TAM is not interesting? Is purely because the valuations is not going to kick in. Speculative valuations and selling is not going to happen to the next investors. By law of the land, you can't, as a VC firm, you can't really have dividends. So it is only that we are a leverage buyout or a merger or a management buyout or an exit that will happen. So it is all about selling it to the next player. This entire landscape of valuation is all about selling it to the next player. Obviously, a lot of people will talk about responsibility that comes with investments because you have to be extremely flexible. So the first kind of investment and the second kind of investment also rely on the fact is how flexible as an entrepreneur you are. The first thing that I ask, whether mentoring a startup, whether investing in a startup, first thing I ask is whether they're really interested in sharing out with people. If somebody thinks that 100% of 1 lakh or 1 crore or 100 crores is good enough, don't get investment. But somebody thinks that 1% of a 1 million is more.
Yeah. Keep your mic more
Right.
than
Sorry about that.
half your sentence.
Sorry about that.
It's very critical to know exactly.
Sorry about that. So yes. So at the end of the day, what happens is that the TAM has to be high, so the valuation gains can be big. Your profile has to be good, the idea, the POC of the market has to be good. So either the opportunity or the person has to be really cracking to get investment. Now, good. That's not a very encouraging news for entrepreneurs, right? Now I'm going to give you an encouraging news. What has happened over the last 3 years is a lot of people have seen the startups makes money. So a lot of people who are not traditional startup investors have joined the angel networks, have joined investment communities, CICs. In a typical VC investment, you need to give 1 crore a year to be a sleeping partner or a limited partner. A lot of that has been seen. Following that was Paytm fiasco or the Zomato's fiasco and everything, and people started reacting, and this non-traditional funds that has come to the market has suddenly gone up, and hence the funding winter is coming. So these volatility is always going to be there. The next phase that is going to come, which has already come in, is where the investments coming from seasoned entrepreneurs who are coming, not from VCs or banks. If you see the ecosystem in US ecosystem or a Chinese ecosystem, the entrepreneurship lead or the springboard or the point of inflection happens when entrepreneurs come into the system and start investing again. And that has started in India. Right. Again, having said all of these things, to really approach this problem is very simple. I always say this and I'm going to repeat this. Your first source of funds should come from your paying customers. If you fail to do that, then only go for investment. Because otherwise it's very difficult to justify investment. Getting your first seed investment, early stage investment, people say it's very difficult. It is, because out of the 100 pitches I would hear, 99 of them are pretty much not there not even hitting the ballpark. So the one who is hitting the ballpark is easy to get funding for them. And I'm talking about easy, comparatively easy. But probably you get 1 crore, 2 crore of funding at a valuation of 5 crores or 10 crores in the initial round. Out of 10 companies, only 1 company will get the next series of funding. So back in the year 2000, I'm giving this up. Back in the year 2015, Urban Clap was just born. At that point of time, services on click, right? Sorry about that. I forgot. Services on click, like electrician, plumbers, and stuff like that. About 153 companies were born in 1 year. Out of which 71 of them are funded. And even the next 5 years, most of them are gone because internet is winner takes it all game. So this is the thing. So 1 crore from a large VC or an investor is nothing. A lot of times people invest to park that venture. So first round of investment is very easy.
So now I come to Neha, so if you can, now that we got to hear 2 of the panelists on various thematic areas linked to investment. So let's say this investor pitch. So let's say people prepare, and those who have participated in various pitch competitions, etc. Everybody, based on the type of organization, whether it is incubator, etc., probably comes up with a new template. Maybe the thinking is very similar, but still the template looks different. So probably if you have prepared yourself in terms of what is that, the storyline, etc., that gets probably a little disturbed in the process. So if you want to talk to them.
Yeah, absolutely. Yeah, hi everyone. Such a pleasure to be here. And I'm managing partner at MeritX Ventures, where we are a cross-border tech-focused venture studio. We help scale startups make them go from 0 to 1, ideation to fundraising. And we work on the investor readiness aspect of it with startups internationally, in India, in the Middle East, and North America. So just bringing that perspective in, and I'm also the founder of Rise Union, which is a community to advance women's participation and leadership in tech entrepreneurship. So just bringing those perspectives to the fore here, I just want to speak about, what matters, when we pitch and why it matters. So let me throw a statistic. So just globally, just 1% of VC funding goes to women-owned startups. Just 1%. Now, so therefore, it is crucial that we make the best out of the opportunities we get, and the pitch, the investor pitch is that opportunity. So I want you to think. Actually, I've prepared a presentation, but I think we have a different setting for that. So I don't know if that's visible because of the lighting on. It is.
Yeah.
And am I audible as well? So I can just take you very quickly through it because that will help me kind of show you what we are on about here.
So,
Yeah. So a couple of things that I want to touch on. Can I stand? Is it okay?
yes.
Yeah, so just want to kind of take you through, the purpose of an investor pitch very quickly, and why you need to align with investor thesis and what that is in a moment, and the key components of an investor pitch, and template or no template, which is what the question was asked to me. I'll address that in a moment, and then of course how you perfect your pitch delivery. So as I said, this is an opportunity, that you get. A pitch is an opportunity to inspire, to excite, and persuade a potential investor, right? Because, equity investors are patient capital, and a lot of people here asked about, how equity investors can be great growth partners, right? Because they don't just write checks, they also bring in networks, they help you co-build your company. So how do you get them interested? This is how you get them interested, by a great pitch. A well-crafted pitch can create early credibility, trust, and foster investor confidence. So this is not a one-way discussion by any means. This is not a one-way presentation. A pitch is very much a two-way dialogue that you are initiating. What you want is to set the context of having a relationship and a model to engage with investors over a longer period of time. So that's what you're looking to do. It's not a test, it's not an exam that you just go in front of an investor and take your 15 minutes and it's a do or die. It's a way to get their interest, to engage with you over and over again. So think long term, right? And what do investors look for? So when you go to them, you talk to them, you show them or tell them your idea. So what is it that they're looking for? So what they're looking for is a couple of things that my fellow panelists have touched upon. So very quickly, think of it as product market fit, founder market fit, traction, scalability, business model, and team. So very quickly, what do these things mean, right? Product market fit is basically the degree to which your product or your solution is addressing market demand, right? Is there a market for what you're building? This is the question. Founder market fit. So are you the right person to be building it? That is what they're interested in. Then traction. Do you have any early evidence that there is a market that exists, a validated market for what you are building? Scalability. My fellow panelists have already spoken about how important that is for a VC or an equity model, where the investor is exit oriented, so they care about whether or not our business is scalable. And the business model. Business model is how you make money, your unit economics. They have to be in place. And finally, the team. So it's not just you. It may be your company, but it's not just you. It's also your team that's going to execute your vision, right? Are you the right person, the people to do that? So what you have to do is align your pitch with investors' thesis. So any investor you talk to, they're not a homogeneous group. They're very heterogeneous. So how are they different from one another? Their investment focus You need to study your investor. You need to study who you are talking to in terms of what are the sectors they're interested in, what kind of investments they do, what kind of rounds they come in. So do they come in very early? Are they early stage? So are they like pre-series A, or are they like seed stage, or they are later investors? They look at series B onwards. You have to do that homework, and you have to align whatever you are saying to those investors, what they want to know or what they want to hear. So that brings us to the components of an investor pitch. So these are the core elements. So what is the core elements here? The problem that you are solving, the unmet need that you are addressing. Solution is your unique value proposition. How are you solving that problem, right? Market opportunity, is it a large enough problem to solve? So TAM, right? And then the business model, how you make money solving that problem. Do people pay to solve that problem, to get that problem solved? And your DNA. So what is your DNA? DNA is your vision. What do you plan to build, right? Your mission, values, goals. And now we come to a typical pitch structure. And here in a minute, I'm also going to be answering the question that Sumanji asked. So this is a typical pitch structure. Like, you have an introduction, you have problem and opportunity, followed by your solution, value proposition, business model, market analysis, competitive analysis, go to market, which means how are you, going to your first set of customers, your team slide, traction, financial projections, and finally ask. Ask means how much money are you looking to raise, and what are you going to do with that money? What is the use of funds? Now this is a typical pitch structure, but is it the only right answer? No, not necessarily, because this is the most important thing. The most important thing in a pitch is the story, right? And your story can be different, and it's going to be different from any other entrepreneur's story. So first and foremost, you must own your story. So there isn't really a template. If you look at, for example, you go to Uber's pitch deck, you'll find it to be very different from this structure. So is it a wrong one? No, it's helped them raise billions of dollars in funding. So what Uber was doing was it was owning their story. So you have to own your story. You have to communicate one central idea per slide. You have to have a storyboard, which means that there has to be a narrative that flows. Like we read a storybook, it has to be like that. The when, the why, the how, all of it has to be ordered in a way. And finally, what you can do is you can humanize your problem, right? So what are the problems worth solving? The problems that connect with us at a human level, at an emotional level. So how do you perfect your pitch? You can have clean, elegant, contemporary design, keep it simple. You have to prepare, guys. For every pitch, before every meeting, or with an investor who can be your partner in helping you build your venture, you must prepare, right? Use the right visual aids, practice, have the body language, have the confidence. Don't go without your confidence. Now, very, very important. I've been in so many demo days, and I think it's like kind of my job has it to be looking at pitches day in and day out. So I want to share what not to do in a pitch, because I feel that's kind of under-addressed throughout. Overloading with information. So as investors, there's limited attention spans. When we think that we are well-intentioned and giving out a lot of information, what does end up happening is that we're really oversharing, right? We need to know how to communicate the central idea. More information can always be shared later. We don't have to provide too much upfront. Making unsubstantiated claims. So guys, while we need to know our market, we need to know our TAM, but we need to also use reliable data sources. Our investors are going to ask us, and they can question us at any point. We don't want to come across as somebody who's not credible. Claiming we have no competition. Please never do that. I've met a lot of founders who say, oh, we have no competition. We are building something entirely unique. But that's not actually how it goes. You always have direct or indirect competition. So even though you have the most novel idea, show that you know your market. Show that you know the players, nationally, internationally, locally, right? So you need to know the landscape. Not defining the market correctly, I think we've already been through this. Not having a business model, you have to think about how we're going to be making money. And ignoring the ask. A lot of pitch decks don't have an ask slide. So they don't have a slide on how much money you need. What are you going to do with that money? What is the, the time frame or the roadmap of that investment? So you need to have that in place. Failure to engage. You have to keep the conversation two-way. We've been through that. And of course, neglecting to practice. I keep going to that. And that's that. I think it's a wrap now. So thank you so much. Thanks for bearing with me. I hope this was helpful. Thank you.
Thank you. All three of them are going to be here. So it was more of an introduction to all of you. We can ask many questions. I have a lot of questions, but I don't want to do that because they're going to be here. They're going to be here listening to some of your pitches. In the meanwhile, those who are not pitching in front of them, please use this opportunity because all of them, as you would appreciate, that they're investors. So they are probably, if they are spending money here, spending time here, they're probably giving up on a discovery opportunity. So let's not, let's try and do justice to that. If they're here, please spend some time with them, try and understand because this is an opportunity to be able to, not essentially getting access to fund or what kind of funds and stuff like that. But how to prepare, and she has laid it down very well. Please prepare your story, those who are pitching, and she has also laid out something in terms of what not to do. So please avoid doing that. Prepare in the meanwhile, but I think later in the day we have the pitching rounds. And once again, thank you very much.